Welcome to the Deep Dive. Today, we're tackling quantitative methods for finance. Think of this as equipping yourself with the essential tools to really understand the numbers behind investing.
Yeah, the toolkit, basically.
Exactly. And our roadmap comes from materials designed for the CFA Level 1 exam.
Right. And we've got a pretty comprehensive set of information here. It covers everything from the different ways to interpret an interest rate all the way to how big data is, reshaping the entire financial landscape.
That's right. We're going to extract the core concepts around calculating and understanding rates of return, arm ourselves with key statistical measures,
So real nuts and bolts.
explore the logic of hypothesis testing, and even get a handle on regression analysis.
And fintech, too. Can't forget that.
And to top it off, we'll see how fintech and big data are being used in investments. So for you, the learner, our goal is to cut through the complexity and deliver the essential insights, those aha moments, where you see how these fundamental quantitative ideas play out in the real world of finance.
So where should we start? How about with something that seems simple, but actually has surprising depth: interest rates?
Good starting point. It's definitely more than just a single number, isn't it?
Absolutely.
Yeah.
Our sources highlight that an interest rate can serve different purposes. It can be the required rate of return, the minimum compensation investors demand.
Okay.
It can also be a discount rate, the tool we use to figure out the present value of future money.
Right, for valuation.
And crucially, it represents the opportunity cost which you're giving up by choosing one investment over another.
So the same number tells a very different story depending on the context. That makes sense.
Precisely. And these interest rates aren't just pulled out of thin air. They have underlying components.
Okay, what are those?
At the base, we have the real risk-free rate of interest. Then, layered on top, are premiums that compensate for various risks. Expected inflation. The chance the borrower might not repay, that's default risk.
Right.
How easily you can sell the investment, the liquidity premium.
Okay.
And how long the investment lasts, the maturity premium.
Got it. So when we talk about the nominal risk-free rate, that's essentially the theoretical return on a risk-free investment plus something for inflation.
Exactly. It's the real risk-free rate plus the premium specifically for expected inflation.
Yeah.
Gives us a baseline, sort of, for returns without major risk factors.
Okay. Now let's move to returns, which is, the bottom line for any investor.
But the rubber meets the road.
Yeah. Our sources tell us that the total return on an investment boils down to two main things. What are they?
Okay, first component is the income yield, the cash you receive periodically, like dividends from stocks or interest payments from bonds. The second is the capital gain or loss, which is simply the change in the market price of the asset over your investment period.
Simple enough.
Both of these together give you the total return.
And the holding period return. That seems pretty straightforward. It's just the total return over whatever period we're looking at, right?
It is, yeah. It's the total return for that specific time frame. Could be a day, could be 10 years.
But are there any subtleties? Like comparing different holding periods?
Good point. The key is that you can't directly compare holding period returns for different lengths without annualizing them. We'll probably get to that.
Okay.
But yeah, a 5% return over 1 month isn't the same as a 5% return over a year when thinking about overall performance. It needs adjustment.
Right. Now, when we look at returns over multiple periods, things get, a bit more interesting.
Definitely.
We have different ways to calculate an average return, and each tells us something slightly different. Let's start with the arithmetic mean, the simple average.
Okay. The arithmetic mean is calculated just by adding up all the periodic returns and dividing by the number of periods.
Simple.
Very simple to understand. But as our sources point out, it can be heavily influenced by extreme returns.
Right. Outliers.
Exactly. One really good year or one really bad year can disproportionately skew the average, potentially giving, a misleading picture of typical performance.
Which brings us to the geometric mean. This one's often described as a better indicator of how a portfolio actually grows over time. Why is that?
The geometric mean takes into account the compounding effect of returns. It shows the actual rate at which your wealth has grown over the period.
Compounding. Okay.
Think of it this way. If you lose 50% one year, you need 100% gain the next year just to get back to even, right?
Right.
The geometric mean captures this reality, whereas the arithmetic mean might just average those to a positive number, which isn't reflective of your actual outcome.
How's it calculated again?
The formula involves multiplying 1 plus each return together, taking the nth root, where it is the number of periods, and then subtracting 1.
Our sources give a striking example. Returns of its negative 50%, plus 35%, and plus 27%.
Yeah, I remember that one.
The arithmetic mean is a positive 4%, but the geometric mean is a negative 5%.
Huge difference.
That really highlights the impact of that big loss. So if an investor is focused on their long-term wealth actually growing, the geometric mean gives them a more realistic picture.
Exactly. It reflects the sequence of returns and their impact on the base capital for subsequent growth. It's generally true that the geometric mean will be lower than the arithmetic mean.
Okay.
And the more volatile the returns, the bigger that difference will be.
And then there's the harmonic mean. That sounds a bit more specialized. When would this be the right measure for returns?
Yeah, it's less common for simple returns. The harmonic mean is particularly useful when you're averaging ratios or rates, things expressed in terms of per unit of something else.
Like PE ratios.
Exactly, like averaging price-to-earnings ratios across a group of stocks. When applied to returns, you first convert each return into a wealth relative. That's 1 plus return.
Yeah.
Then calculate the harmonic mean of these wealth relatives, and finally subtract 1 to get the harmonic mean return. The material mentions it works well in situations with compounding formats.
Okay, so each of these averages gives us a slightly different lens, depending on what we're trying to understand.
Right, different tools for different jobs.
Now, let's think about how the timing of our investments can affect our perceived returns. This leads us to the distinction between money-weighted and time-weighted returns.
Ah, yes. Crucial difference.
What's the key thing an investor needs to grasp here?
Okay, the money-weighted return, which is essentially the internal rate of return, IRR, of the investment, is directly impacted by the timing and size of cash inflows and outflows. Imagine you invest a large sum right before a market downturn.
Ouch.
Yeah. That negative performance will have a significant drag on your overall money-weighted return.
So if I add a lot of money right before a dip, my personal return might look worse than the actual performance of the investments themselves.
Precisely. It reflects the return you earned on the actual capital you had invested at each point in time.
Okay. And time-weighted.
The time-weighted return, on the other hand, is designed to measure the performance of the investment portfolio itself, independent of when investors add or withdraw funds.
So it takes my lumpy contributions out of the picture.
Exactly. It's the standard way to evaluate the skill of an investment manager.
How do we actually separate the manager's ability from the investor's cash flow decisions then?
Well, to calculate the time-weighted return, you need to value the portfolio immediately before any external cash flow, like a deposit or withdrawal.
Okay, snapshot before the change.
Then you calculate the return for each sub-period between these cash flow events.
Right.
And link those returns together geometrically. For practical purposes, daily valuation is often used as a close approximation.
Our sources use the Walbright Fund as an example. They started with a value, had some gains, a dividend reinvestment, and then a big new investment came in.
Yeah, typical scenario.
So to get the time-weighted return, we'd calculate the return before that new money, then the return after, and combine them.
Exactly. The initial period had a certain return. The period after the new investment had its own return. By geometrically linking these sub-period returns, you get the overall time-weighted return for the year.
And that isolates the fund manager's performance.
Right. The money-weighted return, in contrast, would be heavily influenced by the timing of that large investment.
Okay, so if we're trying to judge how good a portfolio manager is, time-weighted return is the more reliable metric.
That's the key distinction. Yes, both are useful, but for different purposes.
Yeah.
Money-weighted tells you how you did based on your timing.
Right.
Time-weighted tells you how the manager performed with the assets they controlled.
Got it. Now, let's talk about annualizing returns. We often see returns quoted as annual figures, even if they occurred over, say, a month or a quarter. Why do we do this?
Well, annualizing allows us to compare investment performance across different time horizons on an equal footing, apples to apples.
Makes sense.
To annualize a return from a period shorter than a year, you essentially compound that return over a full year.
Okay.
So a monthly return is compounded 12 times, a quarterly return 4 times, and so on. The formula takes the periodic return, adds 1, raises it to the power of the number of periods in a year, and then subtracts 1.
Okay, that gives the annualized rate.
Yep.
And if the compounding isn't annual, like if interest is paid monthly, the formula for present value calculations needs to adjust too, right?
Oh, absolutely. You'd use the interest rate per compounding period, the monthly rate in your example, and the total number of compounding periods. So 120 months for a 10-year loan with monthly payments, not just 10 years.
Right, using the periodic rate in periods.
Precisely.
There's also this concept of continuously compounded returns. Sounds a bit theoretical.
It is a bit more abstract, yeah. But continuously compounded returns have a very convenient mathematical property.
Wow.
They are additive over time.
Additive. How so?
If you have a series of continuously compounded returns for different subperiods, the total return for the entire period is simply the sum of those individual returns.
Ah, okay. No complex geometric linking needed.
Nope, just add them up. Our source shows the equation involving the natural logarithm.
Where is this used?
While it might seem abstract, this property simplifies calculations in some important financial models, like the Black-Scholes option pricing model, as mentioned in our material.
Okay, useful in specific modeling contexts. Finally, when we look at returns, we see the terms gross and net return. What's the key difference for an investor?
Pretty straightforward. A gross return is the total return of an investment before any management fees, administrative expenses, or other fund costs are deducted.
Before fees?
Right. Trading expenses, though, like brokerage commissions, are typically included in the gross return calculation because they're part of the investment process itself.
Okay. And net?
The net return is what the investor actually receives in their pocket after all those management fees and expenses have been taken out.
So net is what matters for my actual wealth.
For your bottom line, yes. But when evaluating the skill of an investment manager, looking at gross returns can be more informative.
Why is that?
Because it removes the impact of varying fee structures between different funds or managers. You're comparing their raw investment skill.
Okay, so to really assess a manager's talent, focus on the gross return before fees potentially cloud the picture.
Generally, yes.
Okay, that gives us a solid understanding of rates and returns. Now let's move on to statistical measures. These are essential for analyzing this return data and understanding the associated risks.
Absolutely. You need stats to make sense of the numbers.
We'll start with measures of central tendency. What are the core ones we need to know?
The primary measures are the mean, specifically the arithmetic mean we already discussed, the median, and the mode.
Right. Mean, median, mode.
The arithmetic mean is the sum of all values divided by the number of values. We know it's sensitive to outliers. The median is the middle value when the data is ordered, so it's much more robust to those extreme outliers. And the mode is simply the value that appears most frequently in the dataset. Our source notes that the mode is really the only measure of central tendency you can use with nominal data-like categories.
We also encounter the term quantiles quite a bit.
Yeah.
What exactly are these, and how are they practically used in finance? Maybe a real-world example.
Sure. Quantiles are values that divide a data set into equal portions. The median is a 2-quantile. It splits the data in half.
Okay.
Quartiles are 4 quantiles, dividing it into 4 equal parts. Then you have quintiles, 5, deciles, 10, and percentiles, 100.
And how are they used?
In finance, they're incredibly useful for ranking and comparison. For instance, Morningstar uses percentiles of historical performance to assign star ratings to mutual funds.
Ah, the star ratings.
Yeah, if a fund is in the top 10% of its peer group, the 90th percentile or higher, it gets 5 stars. Investment research also uses deciles to categorize stocks by market capitalization.
Like large cap, mid cap.
Exactly. The top 10% might be large cap, the next 10% mid cap, and so on. This allows for performance comparisons across different size segments of the market.
Okay, so quantiles help us see where a specific data point falls within the broader distribution, crucial for relative comparisons.
Precisely.
Now, knowing the average isn't enough, we also need to understand how spread out the data is its dispersion.
Right, the variability.
What are the key measures of dispersion we should be familiar with?
The main ones include the range, simply the difference between the highest and lowest values. Easy, but sensitive to just 2 points. Then there's the mean absolute deviation, MAD, which averages the absolute differences from the mean. And then the most common ones, variance and standard deviation. Variance is the average of the squared differences from the mean.
Squared differences.
And the standard deviation is simply the square root of the variance. Standard deviation is particularly useful because it's in the same units as the original data.
Making it easier to interpret.
Yeah, it tells you the typical deviation from the average in understandable units.
Our material also mentions target downside deviation. How does this differ from standard deviation in how it looks at risk?
Good question. Target downside deviation focuses specifically on the volatility of returns that fall below a certain target level set by the investor.
So only the bad deviations.
Kind of, yeah. Standard deviation looks at all deviations above and below the mean. But if your investment goal is, say, to achieve at least an 8% return, target downside deviation will measure the volatility only when returns fall short of that 8% threshold. It's a more focused measure of risk for investors particularly concerned about underperforming their specific goals.
That makes sense. And then there's the coefficient of variation, or CV. What practical insight does this give us that standard deviation alone might not?
The coefficient of variation is the standard deviation divided by the mean. It's a standardized measure of relative dispersion.
Relative dispersion. Why is that useful?
It's particularly useful when comparing the risk of investments that have different average returns.
Ah, okay. Example.
Sure. Our source uses one. Say industry A has an average return on assets, ROA, of 10% with a standard deviation of 5%. Industry B has an average ROA of 20% with a standard deviation of 8%.
Okay, B has higher standard deviation. Seems riskier.
Just looking at standard deviation, yes. But the CV for industry A is 0.5, 5 divided by 10. For industry B, it's 0.48 divided by 20.
Ah, so A has more risk per unit of return.
Exactly. The CV helps us compare risk on a level playing field when the average returns differ significantly.
Very useful. Moving beyond just the spread, we also need to think about the shape of the data.
Right. Skewness and kurtosis.
Let's start with skewness. What does a skewed distribution tell us about the likelihood of different types of returns?
Skewness describes the asymmetry of a distribution around its mean. A positively skewed distribution has a long tail extending to the right.
Meaning
You tend to have more frequent small losses, but the potential for a few very large gains. Think venture capital, maybe.
Okay. A negative skew.
A negatively skewed distribution has a long tail to the left. This means you tend to have more frequent small gains, but are exposed to a few potentially very large losses.
Like selling options sometimes.
Could be, yeah. A skewness of 0 indicates a symmetric distribution, like the normal bell curve. The EAA equity index example in our material showed negative skewness,
Right.
suggesting that while small gains might be common, there's a higher likelihood of significant negative returns compared to a perfectly symmetrical distribution. Understanding skewness is crucial for risk management.
And kurtosis. That tells us about the tailedness, or the concentration of extreme values, right?
Exactly. Kurtosis measures the fatness of the tails of a distribution compared to a normal distribution.
What tails mean?
A leptokurtic, or fat-tailed distribution, has more probability in the tails, meaning more extreme values, both positive and negative, than a normal distribution. Think higher probability of those black swan events.
Okay. And thin tails.
A platykurtic, or thin-tailed distribution, has fewer extreme values than normal. The kurtosis of a perfect normal distribution is 3.
Right.
The EAA equity index example also exhibited excess kurtosis, meaning kurtosis greater than 3, reinforcing the idea that extreme market events are more likely than a simple normal distribution would suggest.
So higher kurtosis means more potential for extreme surprises, good or bad.
Yes, definitely critical for stress testing and understanding potential downside risks beyond what standard deviation alone might capture.
Okay. Finally, in our statistical toolkit, we have correlation. It helps us see how different assets or variables move in relation to each other.
A cornerstone of portfolio management.
How do we interpret a correlation coefficient, say, between two stocks, in a practical investment context?
Correlation, quantified by the correlation coefficient, which ranges from -1 to +1, measures the strength and direction of the linear relationship between two variables.
Okay, -1 to +1.
A correlation of +1 means they move perfectly together in the same direction. Net equals 1 means they move perfectly opposite to each other. And 0 suggests no linear relationship.
So in investing?
In investment, a low or negative correlation between different asset classes in a portfolio is often desirable because it can help reduce overall portfolio risk through diversification.
Makes sense. Don't put all your eggs in correlated basket.
Exactly.
Yeah.
Our material uses scatter plots to visually illustrate this, showing, for example, IT stocks versus the S&P 500 likely having a strong positive correlation, while maybe utilities versus the S&P 500 might have a less strong or different correlation.
But it's crucial to remember, and our sources stress, this correlation doesn't imply causation.
Absolutely fundamental point.
And it only captures linear relationships. Two things could be perfectly related in a curve, but show low linear correlation.
Precisely. The Anscombe's quartet example is classic for this, showing how very different data sets can have identical summary statistics, including correlation.
So look at the scatter plot, too.
Always visualize your data. Correlation is a useful starting point, but it's definitely not the whole story when understanding how assets interact.
All right, we've covered a lot of foundational ground with rates, returns, and descriptive statistics. Let's shift our focus now to probability concepts.
Okay, dealing with uncertainty now.
Which is central to finance. Where do we begin with probability?
We start with the fundamental concept of expected value.
Okay, what is it?
Think of it as the long-run average outcome if a random event were repeated many, many times. It's calculated as the sum of each possible outcome multiplied by its probability, a probability-weighted average.
Got it. And then we have conditional expectations. When would we use these?
Conditional expectation is the expected value of a random variable, given that a specific event has already occurred. It lets us update our expectations based on new information.
Update. Okay.
The formula in our source essentially reweights the possible outcomes based on the probability of them occurring, given that conditioning event happened.
Like the Bancorp example.
Exactly. The Bancorp EPS example illustrates this well. It shows how the expected earnings per share changes depending on whether interest rates are forecast to go up or down. Our expectation becomes conditional on that interest rate scenario.
So if we get new info, like a revised rate forecast, conditional expectation helps us adjust our outlook for Bancorp's earnings.
Precisely. And this leads us naturally to the total probability rule for expected value.
How does this help when we have multiple possible scenarios, like rates up, down, or stable?
The total probability rule for expected value allows us to calculate the overall expected value when there are several mutually exclusive and exhaustive conditions or scenarios. We calculate the expected value under each condition, like the conditional expectations we just discussed, and then take a weighted average of these, where the weight are the probabilities of each condition occurring.
So back to Bancorp.
Yeah, the example continues, showing how to calculate the overall expected EPS by considering both the declining rate scenario and the stable rate scenario, weighted by their respective probabilities. Gives you the overall picture.
Probability trees seem like a really intuitive way to visualize these sequences of events.
Oh, definitely. Especially when things get a bit more complex with multiple stages or decisions.
What do they show?
Probability trees map out the different possible paths an event can take, along with the probability of each branch or step. By following the branches, you can easily calculate the probability of reaching a particular final outcome.
And use those for expected values.
Exactly. You can then use these joint probabilities to determine expected values. Our material mentions an example of forecasting operating costs based on branch expansion decisions. A tree helps visualize all the possibilities.
Now, Bayes' formula. This sounds powerful, like a way to formally update our beliefs.
It is very powerful. It's a cornerstone of statistical inference.
Can you give us an intuitive sense of how it works without getting lost in the math?
Okay, imagine you have an initial belief about the probability of something happening. That's your prior probability.
My starting guess.
Right. Then you receive some new information or data. Bayes' formula provides a mathematical way to revise your initial belief to arrive at a more informed probability, your posterior probability, based on this new evidence.
So it combines my prior belief with the new data.
Exactly. The formula, as shown in our sources, takes into account your prior belief, the likelihood of observing the new evidence if your belief were true, and the overall probability of observing that evidence anyway.
The tech firm example illustrates this.
Perfectly. The example shows how knowing that a firm's return is greater than 10%, the new evidence, allows you to update your initial estimate of the probability that it's actually a tech firm, revising your prior belief.
Very cool. Finally, we have the covariance and correlation of random variables. We touched on sample correlation earlier. How do we define these formally for the underlying variables themselves?
Okay, the formula for the covariance of two random variables measures the degree to which they tend to vary together from their means. It involves the expected value of the product of their deviations from their respective means. Our material provides the formal equation using expected values.
And correlation.
Correlation, as we discussed before, is just a standardized version of covariance. It's scaled to range between -1 and +1, making it easier to compare the strength of the linear relationship between different pairs of variables.
And there's a link to independence?
Yes. A key point is that if two random variables are independent, their covariance and correlation will be 0.
Makes sense. If they're independent, they don't move together.
Right. But the reverse isn't always true. A correlation of 0 doesn't automatically mean independence. There could be a nonlinear relationship.
Got it. 0 correlation only rules out a linear link. Okay, probability concepts equip us to quantify and manage uncertainty. Now let's think about how we actually get the data we use. This brings us to sampling methods.
Right. How do we pick who or what to measure?
What are the different ways we can select a representative subset from a larger population?
Well, there are various sampling techniques. Probability sampling methods are key because every member of the population has a known non-zero chance of being selected.
Like what?
Simple random sampling gives everyone an equal chance. Stratified random sampling involves dividing the population into subgroups, or strata.
Based on characteristics.
Yeah, like industry sector or company size. Then you draw a random sample from each stratum, often proportionally. Cluster sampling involves dividing the population into clusters, say geographic regions, and then randomly selecting a few clusters to sample all members from within those chosen clusters.
Okay. Any others?
Systematic sampling selects members at regular intervals from an ordered list, like every 10th name.
What about non-probability sampling? When might we use those?
Non-probability sampling methods don't guarantee every member has a known chance of selection. Convenience sampling just selects readily available individuals.
Easy, but potentially biased.
Exactly. Judgmental sampling relies on the researcher's expertise to choose a sample they believe is representative. These methods can be quicker and cheaper, but they are more susceptible to bias because the selection isn't random. This makes it much harder to confidently generalize findings to the entire population.
Okay, so once we've collected our sample data, hopefully using a good probability method, how do we use it to make inferences about the broader population?
This is where the central limit theorem comes in. It's incredibly important.
Right. Can you remind us of its core idea?
Absolutely. The central limit theorem, or CLT, states that for a large enough sample size, usually considered 30 or more, but it depends.
Okay.
The distribution of the sample mean will be approximately normal, regardless of the shape of the original population distribution.
Even if the population is skewed?
Even if the population is skewed or weirdly shaped, as long as the sample is large enough, the distribution of possible sample means will look like a normal bell curve.
Wow. And what about the mean of that distribution?
And crucially, the mean of this distribution of sample means will be equal to the true population mean.
That's powerful. It lets us use the normal distribution for inferences.
Exactly. It allows us to use the well-understood properties of the normal distribution to make probabilistic statements about the population mean based on just a single sample mean.
And the standard error of the sample mean, how does that fit in?
The standard error of the sample mean is the standard deviation of that distribution of sample means we just talked about from the CLT.
Okay, the standard deviation of the means.
It essentially measures how much variability we can expect for the one sample mean to another if we were to repeatedly draw samples from the same population. The formula shows it's the population standard deviation divided by the square root of the sample size.
So bigger sample, smaller error.
Precisely. In practice, since we often don't know the population standard deviation, we typically use the sample standard deviation as an estimate to calculate the standard error. A smaller standard error indicates our sample mean is likely closer to the true population mean.
So, the CLT gives us the shape, standard error gives us the spread. This allows us to build confidence intervals and perform hypothesis tests.
Exactly the foundation.
Let's dive into hypothesis testing then. What's the fundamental process we follow?
Hypothesis testing is a structured, formal way to decide between two competing claims about a population parameter using sample data.
Okay, the steps.
First, state the hypotheses. The null hypothesis, H0, which is the claim we want to test, often representing no effect or no difference, and the alternative hypothesis, which is the claim we'll accept if we reject the null. Then choose a significance level, alpha.
Alpha, the error tolerance.
Yes, it's the probability of rejecting a true null hypothesis. We'll come back to that. Then select an appropriate test statistic, like Z, T, F, chi-square, based on what you're testing and your data. Formulate a decision rule based on alpha and the test statistics distribution. Then, calculate the test statistic from your sample data. Finally, make a decision. Reject H0 or fail to reject H0 based on whether your calculated statistic falls into the rejection region defined by your rule.
It sounds like in making these decisions, we could end up making the wrong call.
Absolutely. There's always uncertainty when inferring from samples.
Tell us about type I and type 2 errors. Why do they matter?
Okay, a type I error occurs when we reject the null hypothesis when it's actually true. Think of it as a false positive. The probability of making a type I error is exactly equal to our chosen significance level, alpha.
So if alpha is 5%, there's a 5% chance of a false positive.
Correct. A type 2 error occurs when we failed to reject the null hypothesis when it's actually false. This is a false negative. We miss detecting a real effect or difference. The probability of this is called beta.
Understanding these errors seems crucial.
Definitely. They highlight the inherent trade-offs in statistical decision-making.
So the significance level we choose, alpha, is our tolerance for a false positive.
Exactly.
How does that trade off with the risk of a false negative type 2 error?
There's an inverse relationship.
Yeah.
By lowering alpha, say from 5% to 1%, you make it harder to reject the null. This decreases your chance of a type I error, false positive.
Okay.
But it increases your chance of a type 2 error, false negative, beta goes up. You become more likely to miss a real effect.
And vice versa.
And vice versa.
Uh-huh.
Increasing alpha makes it easier to reject the null, reducing beta, but increasing the risk of a type I error. The optimal balance depends on the specific context and the relative costs of making each type of error.
Right. We have different test statistics for different scenarios. Can you give us a quick rundown of when we'd use some of the common ones like T, chi-square, F, and Z?
Sure. We typically use a T statistic when testing hypotheses about a population mean and the population variance is unknown, which is very common practice.
Okay, T for mean, unknown variance.
The T-squared statistic is often used for tests involving the variance of a single normally distributed population, or for tests of independence with categorical data.
Chi-square for variance or categories.
Got it. The F statistic is used when comparing the variances of two independent normally distributed populations, or in ANOVA analysis of variance, to compare means across multiple groups.
F for comparing two variances or multiple means.
And the Z statistic is used for tests about a population mean when the population variance is known, which is rare. Or, importantly, when we have a large sample size, thanks to the central limit theorem allowing us to approximate with a normal distribution.
Z for mean, known variance or large sample. Okay. And when we're comparing means of two groups, we need to distinguish between independent and dependent samples.
Yes, that's important. When comparing the means of two unrelated groups, say, the returns of growth stocks versus value stocks, we use tests for independent samples. When we're comparing the means of the same group at two different time points, like a company's sales before and after an ad campaign, or when we have matched pairs, like husband-wife data, we use tests for dependent or paired samples.
And the tests are different.
Yes. The statistical tests used are different to account for the potential correlation within the paired data. Paired tests are generally more powerful if the pairing is meaningful.
We can also perform hypothesis tests specifically on variances, not just means.
Yes. As mentioned, the chi-square test is the typical choice for testing a hypothesis about a single population variance. For example, is the variance of fund returns equal to some benchmark value?
Okay.
When comparing the variances of two independent populations, the F test, which looks at the ratio of the two sample variances, is the appropriate tool. Your example, do these two production lines have equal variability?
Finally, our sources distinguish between parametric and non-parametric tests. When should we consider using a non-parametric test?
Okay. Parametric tests, like the t-tests and f-tests we discussed, rely on specific assumptions about the distribution of the underlying population, most commonly the assumption of normality.
Right. They assume a certain shape.
Non-parametric tests make fewer or less stringent assumptions about the population distribution. They're sometimes called distribution-free tests.
So when do we use them?
We should consider using non-parametric tests when those parametric assumptions are clearly violated, for instance, if the data is strongly skewed or has significant outliers that distort the mean and variance.
Okay.
Also, when our data is inherently ranked ordinal data rather than continuous, or when our hypothesis isn't focused on a specific population parameter like the mean or variance, but maybe on the median or the overall distribution shape.
Any examples?
Our material mentions the Spearman rank correlation as a non-parametric alternative to the standard Pearson correlation when normality can't be assumed. It works on the ranks of the data. And the chi-square test for independence, which we mentioned for categorical data, is also a non-parametric test. It checks if two categorical variables are related, like maybe ETF size category in investment objective.
And we can test correlation itself.
Yes, you can use a t-test to specifically test if the population correlation coefficient is significantly different from 0.
So hypothesis testing gives us a rigorous framework, but we need to be mindful of assumptions and potential errors.
Absolutely. It's a powerful tool, but not infallible.
Now, let's move on to simple linear regression. What's the core idea behind this technique?
The primary goal of simple linear regression is to model the linear relationship between two variables. A dependent variable, often called y, the one we want to predict or explain, and a single independent variable, x, the one we think influences y.
And the model looks like?
The model is represented by the equation y equals b0 plus b1x plus Amos Salon.
Okay, break that down.
Y is the dependent variable. X is the independent variable. But 0 is the y-intercept, the predicted value of y when x is 0. B1 is the slope coefficient, the change in y, for a one-unit change in x. And A is the error term, capturing everything else that affects y, but isn't included in the model.
The unexplained part. How do we actually estimate the values of B0 and B1 from our data?
We use the method of ordinary least squares, or OLS.
Least squares. Minimizing errors.
Exactly. The idea is to find the line that best fits the scatter plot of data points by minimizing the sum of the squared vertical distances between the actual data points, y values, and the predicted values on the regression line, the y-hats.
Y squared.
Squaring makes all errors positive and penalizes larger errors more heavily. It also has nice mathematical properties.
Yeah.
These vertical distances are the residuals representing the error term for each observation.
So OLS finds the B0 and B1 that make the sum of those squared residuals as small as possible.
Precisely. That gives us the best fitting line according to that criterion.
Once we have our estimated intercept, B0, and slope, B1, how do we interpret what those numbers actually mean?
Okay, the intercept B0 is the predicted value of y when x is 0. It's really important to ask if x being 0 is actually meaningful or even possible in the context of your problem. Sometimes it is, sometimes it's just a mathematical construct.
Okay, and the slope?
The slope coefficient, B1, is usually the more interesting one. It represents the estimated change in the dependent variable, y, for a one-unit increase in the independent variable x.
So it tells us the direction and strength of the relationship.
Exactly. A positive slope means as x goes up, y tends to go up. A negative slope means as x goes up, y tends to go down. The magnitude tells you how much y changes for that one unit change in x.
After we fit a regression line, how do we know if it's actually a good fit? Is the relationship strong?
Good question. We need measures of goodness of fit. Several metrics help us assess this.
Like R squared.
R squared, the coefficient of determination, is a very common one. It tells us the proportion of the total variation in the dependent variable, y, that is explained by our regression model, by variation in x.
So a higher R squared is better.
Generally, yes. It ranges from 0 to 1, or 0% to 100%. An R squared of 0.6 means 60% of the variation in y is explained by the model. The remaining 40% is due to other factors, the error term.
What else?
The F statistic tests the overall significance of the regression model. In simple linear regression with just one x, it essentially tests the same hypothesis as the t-test for the slope. Is the slope coefficient significantly different from 0? A low p-value for the F statistic suggests the model is useful.
Okay.
And the standard error of estimate C is another key measure. It's the standard deviation of the residuals, their errors. It gives us an idea of the typical size of the prediction errors made by the model in the units of y. Lower is better.
We can also perform hypothesis tests specifically on the slope coefficient B1, right, to see if the relationship is statistically significant?
Yes, absolutely. We typically use a t-test for this. The null hypothesis is usually that B1 equals 0, meaning no linear relationship between x and y.
And the alternative?
The alternative hypothesis is that B1 is not equal to 0 for a two-tailed test, or that B1 is greater than 0 or less than 0 for a one-tailed test if we have a specific directional expectation.
So the t-statistic tells us if the estimated slope is far enough from 0 to be statistically significant.
Exactly. Considering the uncertainty around the estimate, it's standard error.
And once we have a regression model we trust, we can use it to make predictions.
Yes, that's often a primary goal. To get a predicted value of y for a given value of x, you simply plug that x value into your estimated regression equation. Y hat equals B0 plus B1x.
But that's just a point estimate. How do we quantify the uncertainty around that prediction?
Right. We need an interval. We can calculate a prediction interval. This interval provides a range within which we expect a future individual value of y to fall with a certain level of confidence, like 95%, given a specific value of x.
How is that different from a confidence interval?
A confidence interval is for the average value of y at a given x, while the prediction interval is for a single future observation of y. Prediction intervals are always wider because they account for both the uncertainty in the estimated regression line and the inherent randomness of individual data points, the error term.
Okay, wider for individual predictions. The width depends on.
The width depends on the confidence level we choose. For e.g., 99% is wider than 95%. The standard error of estimate, more scatter, means wider interval. The sample size, larger sample, usually means narrower interval. And how far our x value is from the average x in the data. Predictions are less certain further from the center.
Our sources also briefly mention different functional forms in regression, like log-lin and log-log models. Why might we transform variables?
Sometimes the relationship between variables just isn't linear. Plotting the data might show a curve.
So we transform to make it linear.
Essentially, yes. Transforming one or both variables, example, taking the natural logarithm, can sometimes linearize the relationship, allowing us to use linear regression techniques effectively. For example, a log-lin model, log of y regressed on x, is useful if y grows exponentially with x.
And log-log.
A log-log model, log of y regressed on log of x, is often used when we expect a constant elasticity relationship, where a percentage change in x leads to a constant percentage change in y.
How do we choose the right form?
It's crucial to examine the goodness of fit statistics, but perhaps more importantly, to look at the residuals from different models. The residual should look random, with no obvious patterns, if the model form is appropriate. Theory might also guide the choice.
Finally, in regression, we have indicator variables. How do these let us include qualitative info, like did a policy change happen?
Indicator variables, also called dummy variables, are brilliant for this. They are binary variables that take a value of 1 if a certain condition is met, for example, the policy was in effect, the company is in a specific industry, and otherwise.
And we just put them in the regression as an X.
Exactly. We can include these L1 variables in our regression model as independent variables. For example, in the money supply growth example mentioned, the shift variable likely indicates whether a specific policy change was in effect. 1 if yes, 0 if no.
How do we interpret the coefficient on that dummy variable?
The coefficient on the indicator variable, say B2 if shift is x2, estimates the average difference in the dependent variable, y, money supply growth, when the indicator is 1 compared to when it's 0, holding all other factors in the model constant. So it directly estimates the impact of that qualitative factor, the policy shift.
Okay, simple linear regression is a valuable tool, and indicator variables make it more flexible. Now, let's shift gears completely.
To the future.
To the future. Let's explore the exciting and rapidly evolving world of fintech and big data and investment. What makes this area so transformative?
Well, fintech is fundamentally changing how financial services are delivered, accessed, and analyzed. And a key driver, maybe the key driver, is the availability and analysis of massive data sets we call big data.
More than just stock prices and earnings.
Oh, way more.
Huh?
This includes not only traditional financial data, but also a huge amount of alternative data sources. This surge in data, coupled with massive increases in computing power and sophisticated algorithms, is enabling entirely new approaches to investment management.
Like algo trading and AI.
Exactly. Algorithmic trading, artificial intelligence, AI, and machine learning, ML, are at the heart of it.
So what exactly is big data in finance? It's more than just a lot, right?
But you're right. It's usually characterized by the 3 V's, sometimes more. Volume, just the sheer scale of data being generated. Velocity, the incredible speed at which it's created and needs to be processed. Think high-frequency trading data. And variety, the many different types and formats.
Structured versus unstructured.
Right. Structured data is like spreadsheets and databases. But a lot of big data is semi-structured, like XML files, or unstructured think text from news articles, social media posts, satellite images, sensor data. Finance now deals with all of this.
And how are AI and machine learning being applied to this massive influx of varied, fast-moving data?
Okay, broadly, AI aims to create systems that can perform tasks normally requiring human intelligence, reasoning, learning, problem solving. Machine learning is a subset of AI that focuses specifically on enabling computers to learn from data without being explicitly programmed for every single rule.
Learning the patterns themselves.
Exactly. Find the pattern, apply the pattern. In investment, ML algorithms are used to identify complex patterns in huge data sets, make predictions, like market direction or credit risk, and automate decision-making processes.
Are they different from traditional statistics?
Many ML techniques are particularly well suited to big data because they don't necessarily rely on the same strict statistical assumptions, like normality, that traditional econometric models often do. They can handle messier, more complex data.
You mentioned supervised versus unsupervised learning.
Yes. Supervised learning is where the algorithm learns from data that's already been labeled with the correct answer. Think training a model to predict stock returns using historical data where you know the actual returns.
Okay. And unsupervised.
Unsupervised learning is where the model tries to find hidden structures or patterns in unlabeled data on its own. A common example is clustering, grouping similar companies together based on various financial or operational metrics without predefining the groups.
And deep learning.
Deep learning uses complex, multi-layered neural networks. It's a powerful subset of ML. It's had huge success in areas like image recognition and natural language processing, and it's now being applied to very complex financial problems, trying to find really subtle patterns.
What are some concrete examples of how big data and these techniques are being used in practical investment management today?
We're seeing it across the board. For alpha generation trying to find excess returns, firms are using alternative data like credit card transaction data to predict retail sales or analyzing satellite imagery of parking lots or oil tankers.
Oh.
In risk management, ML algorithms can analyze vast amounts of market and non-market data to identify subtle, emerging patterns of systemic risk that traditional models might miss. What else? Customer profiling in wealth management is being revolutionized by analyzing digital footprints to offer much more personalized investment advice and product recommendations. Algorithmic trading is obviously huge, using AI to execute trades at high speed based on complex, real-time patterns.
Fraud detection. Sentiment analysis.
Definitely. Big data helps detect fraud by identifying unusual transaction patterns, and sentiment analysis, using natural language processing (NLP) to process news articles, earnings call transcripts, social media gauging market mood or sentiment towards specific stocks, analyzing the tone of an analyst report, not just the rating.
It sounds like this requires a very interdisciplinary skill set. That's where data science comes in.
Exactly. Data science is inherently interdisciplinary. It combines computer science, programming, data structures, algorithms, statistics, machine learning, and crucial domain expertise, understanding finance in this case, to extract knowledge and insights from data.
What do data scientists actually do?
They're involved in the whole pipeline: data capture, curation, cleaning and organizing, storage, search, transfer, analysis, visualization, and communication of findings. A big part is data processing, especially for messy alternative data, which often needs specialized treatment and feature engineering to be useful for models.
And visualizing this complexity must be key.
Hugely important. Data visualization techniques like interactive dashboards, heat maps, network graphs to show connections, or even tag clouds to summarize text data are crucial for understanding patterns and communicating findings effectively.
You mentioned natural language processing, NLP. That seems vital for all the text data.
Absolutely. NLP techniques allow computers to understand and process human language text or speech. In finance, this is used for things like scanning news feeds for relevant events, analyzing regulatory filings, summarizing long reports, sentiment analysis as we discussed, even powering chatbots for customer service.
Finally, what are some of the essential tools and technologies someone working with big data in finance would typically use? What's in the toolkit?
Core programming languages are definitely key. Python is hugely popular due to its extensive ecosystem of data science libraries like Pandas for data manipulation, NumPy for numerical computing, and scikit-learn for machine learning. R is another major language, especially strong in statistical computing and visualization.
What about databases?
For managing and querying large data sets, SQL, structured query language, is absolutely essential. For smaller scale data management on a single machine, something like SQLite can be useful. And increasingly, cloud computing platforms like AWS, Google Cloud, or Azure are vital for storing the vast amounts of data and providing the computing power needed for complex analyses.
This has been an incredibly insightful deep dive into quantitative methods for finance. Wow, we've covered so much ground.
We really have. From the fundamental concepts of interest rates and returns, all the way to the cutting edge of big data and machine learning.
We've explored the multifaceted nature of interest rates, delved into the nuances of return calculations like arithmetic versus geometric means, money versus time-weighted.
Equipped ourselves with essential statistical measures: mean, median, standard deviation, skewness, kurtosis, correlation.
Navigated the logic of hypothesis testing, nulls, alternatives, errors, significance levels.
Gained an understanding of simple linear regression, interpreting coefficients, R-squared, making predictions.
And finally, glimpsed the transformative potential of big data, AI, and machine learning in the financial industry.
For you, the learner, these concepts really form a powerful foundation for understanding and navigating the complexities of the financial world. It's the language of modern finance in many ways.
Absolutely. And for you, the learner, this deep dive provides, hopefully, a crucial understanding of the language and tools used in financial analysis day to day. Whether you're making investment decisions yourself, trying to interpret market data you see in the news, or simply looking to enhance your financial literacy, these quantitative skills offer a really valuable perspective.
But remember, this is just an introduction, really. A whirlwind tour.
True.
Each of these areas, from the intricacies of calculating time-weighted returns accurately to the power and pitfalls of regression analysis, and especially the rapidly evolving landscape of fintech and data science, offers vast opportunities for further exploration.
So the learning doesn't stop here.
Definitely not.
Yeah.
We encourage you to revisit these concepts, maybe delve deeper into the areas that particularly sparked your curiosity. Consider how these quantitative tools can empower your own understanding of finance, whatever your goals are.
Maybe ask yourself, what area feels most relevant right now? What questions do these concepts raise for you about the future of investment management or financial analysis? These are really just the starting points for your continued learning journey.